Well, thank you everybody for joining us today on our Contemplating Your Exit series. Super excited today to have Mac Lackey join us. He's got a wealth of not only experience, but ideas and thoughts and concepts that are quite honestly a little different than many guests that we talk to. And that's why we have him here. We want lots of different opinions for entrepreneurs out there that are managing, growing, and someday considering exiting their business. Because there's a lot of ways to do this. So we're going to get started here. I'll let Mac introduce himself in a minute here, but first, well, Mac, maybe you're control. There we go. A little disclaimer. This is all general information. These concepts do apply to large and small businesses. So really focus on the concepts that Mac's going to be talking about here. Whoops. So our overview today, we're going to get into introductions, and then Mac's going to focus on 4 different concepts, focusing on strategic value, developing an irresistible exit story, and how to find the best and think about the best buyers, and really being proactive and not reactive. We will save some time for Q&A, and if you guys have any questions at the moment put it in the chat room, put it in the Q&A. I'll try to incorporate them into conversations, but let's get this started. Mac, for those of you who are in the greater Charlotte area and you read the Business Journal or the Observer, it seems like every couple of years Mac is popping his head up because he continues to be successful in selling his business. He's had 6 company exits at both 7 and 8 figures. He's an angel investor and works with many dozens of companies as a mentor. He served on board of a public company, and maybe most importantly, he's done all of this while maintaining a family life. And as someone who struggles, that could be a whole different session, Mac, that we could do that. So Mac, welcome to the Contemplating Your Exit series, and we're glad to have you here.
Well, thank you, Adam. Yeah, it's always funny when I sort of think about the background. It's the highlight reel. You know, I could spend hours and pages of face punches and mistakes, but yeah, a few things I figured out along the way. So what I will do is I will go quickly into a few things here, because normally when I do these presentations, I have 120 plus slides, and and that's because I really like to get a lot of stuff out there and try to help people. But we've truncated that a lot, so we have time for Q&A. So the only thing I would say about my particular exit journey that's relevant to this conversation is, I have started a number of companies, but they are in different industries. I've had tech companies, I've had media businesses, I've had apparel companies. I've had several opportunities to infuse my passion for soccer, which is kind of a personal passion, with my businesses. So I've had different companies, and then I've also sold to very different buyers. So I've sold to public companies, I've sold to private companies, I've sold to international buyers and domestic buyers. So that diversity of kind of the exit journey is one of the biggest things that's informed kind of the way I think about it today. So I won't belabor my background, I'll just sort of jump in. All right, so clicking here, making sure it's going to go forward, which it's not going forward.
I'll try it. Oh.
Yeah, apologies if there's a delay. We've got people in different locations here managing this. I think one of the biggest things that I think about a lot is if you poll entrepreneurs, regardless of the stage of their business, about 3/4 of them want to sell at some point in the future. And so that's just a very, very common desire. And yet one of the things, and Adam and I have talked about this, is that unfortunately, a lot of people get to the point where they're ready to sell, they want to sell, they need to sell, and they don't really understand or realize that the odds are pretty much stacked against them in terms of even getting to an exit, but certainly in terms of maximizing value. So that's something that I spend a lot of time is just trying to educate people on how do you improve those odds? And there, in a longer presentation, I would be giving you examples of not only are there some organizations that have defied the odds, there are some that do it in very dramatic fashion. You know, there are companies like a division of Motorola that Google acquires for billions and billions of dollars at 85 times revenue. There are examples like WhatsApp, which is acquired by Facebook for billions and billions of dollars with no profit, very few employees. And so there are clearly examples in the media of groups that are not only getting exits, but really defying the odds in pretty extreme ways. And so what I like to talk about is, what is it that these organizations are doing differently that we might copy, that help them defy the odds? What's the secret to their particular success? And so in my view, one of the most important factors is every one of those companies that defies odds in a really extreme way, those unicorns that you read about, they were not financial deals. They were not sold based on an EBITDA multiple or a revenue multiple. You will see in the press many times that someone, a smart analyst, goes back and says that deal was done at 47 times EBITDA or 27 times revenue or some crazy number. And yes, you can reverse engineer the math, but the reason they were acquired was based on strategic value. And someone later said, oh, that was 47 times, right? So the strategic value is what drove the deal. In order to create those kind of outlier scenarios, there are 4 critical things that you need to do that, in fact, most founders do not do. So we'll touch on each one of these really briefly. The first is this overarching idea that you have to shift your thinking away from EBITDA and revenue and margin and really, really deeply focus on strategic value. Now, of course, I will say many times that does not mean that revenue doesn't matter or EBITDA doesn't matter. It just means that the real driver of exit value and exit options is going to be strategic value. So if you take a look at what are different types of strategic value, this is basically what buyers want. Screen's going all over the place.
That might have been me. Sorry, Mac. That might have been me. Sorry.
No problem.
There we go.
Okay, apologies for that. So when I think about this, what I really want you to be thinking is really, really good buyers don't buy businesses because of the cash flow. If you look at, you know, Google buying a division of Motorola for, I think it was $12 billion, Google clearly did not need EBITDA. They clearly did not need revenue. The reality is Google wanted to be in the phone business. They needed a handset. So what they were buying was entrance into that market. They needed a handset. They were willing to pay $12 billion for it. So generally, when you look at your own business and think about what is strategic value, it's things like this. It's that you have unique products and services that you've developed. You might have a brand. That's a really big one. It's been some of my experience that there are companies that are much bigger, much more sophisticated, maybe much further along, that actually don't have a great brand. They want to buy your brand and put it on top of their product set, right? In many cases, intellectual property is a driver of strategic value. You have software, you have a unique processes, you have a patent, a trademark, a trade secret, something that you have put this wrapper of intellectual property around that a buyer really values. In many cases, you could have powerful distribution. So a lot of people will say, greatest product doesn't win. Good product with great distribution can always win. So again, in many of my companies, historically, we had good products, but I had a really interesting distribution channel that really made us unique, right? Exclusivity, a fantastic one. If you're the first to see an opportunity and you contractually lock down a supplier of goods and services, a distribution channel, that contract in many cases can exceed the value of your revenue multiples or your cash on the balance sheet. So exclusivity is a really good example. These are just a few of those things that in reality when you look at your company, that's what a buyer is going to be looking for. They're going to be excited if you're profitable, and if your EBITDA contribution is really significant, that's a huge thumbs up. But what they're really buying is the things that are on this list. Things like this are strategic value. So Adam, are you clicking for it or am I?
You go.
Okay. I just
I believe you are.
step on each other here. Apologies for that.
Not working.
Yeah.
Let me try it again here. There we go. I'll...
All right. So the shift number 2 is you have to develop what I call an irresistible exit story. So in the first piece of this, it's, you've identified an area of your business where you have a lot of strategic value. You have something that the market wants. But part of the challenge is they have to understand why that's really valuable and important. So if we click to the next slide, the
Yep.
best way you can do this is you paint a picture of what's possible. And so when you think about your business and you put it in the hands of a prospective buyer, you're not talking about where you are today, you're talking about where you're going as an organization. What that allows you to articulate is that the strengths that you have now are going to be much more powerful in their hands, right? They're going to be able to do much bigger things. So you're showing them how great your products and services are with their sales team, with their distribution channels. If you have some significant risks or weaknesses that keep you up at night, which most founders do, maybe you're worried about financing your supply chain. That was a real issue for one of my companies. Is we were growing really fast. We had a pretty long supply chain and it was really hard to finance the growth. And so when we started talking to prospective buyers, I knew they were going to hone in on that very quickly. Like, oh, you guys are struggling to finance the supply chain. It was really easy for me to be dismissive and say, the minute our deal closes, you have $100 million on your balance sheet. Our supply chain issues are gone tomorrow. And so you're sort of shifting their thinking from where you are to where you're going to be in the future. So that's a really, really simple but powerful way to keep their eyes looking at the future and looking forward. Yeah, these screens are not going. So let me just go ahead and talk through a few of these. And
You want to go back?
No, that's okay. I just want to kind of hit on these main points,
Okay.
and then we can dig in deeper. So
No problem. So, by the way, Mac, before you get into number 3, I have something in the chat, a question already. Someone said, "I'm in a nice, boring but vital service industry. How do I convince a strategic buyer?" And let's call services. I'll lump it in the plumbing, HVAC, and electrical. It's one of those. How do I convince a strategic of the greater value for my business?
So the way I like to think about it, every business, it's a really good question. Every business is super unique. And, I'll give you kind of knee-jerk high-level thoughts, and then we could dig in more if we want. But what allows you to be successful within an organization? Let's say you have a pretty decent revenue business and pretty decent, EBITDA or profit, and there is some reason that your business is growing and generating profits, and that reason is often the first place to look for strategic value. Is it because you happen to be a really, really good marketer of HVAC services, right? So all things being equal, I don't want to call it a commodity, but there are plenty of people that might be good at doing HVAC work, but you are particularly good at acquiring new customers, or you're particularly good at, when you do service, your logistics model has allowed you to be more profitable than the average HVAC company. So where most people go is look at that great revenue growth quarter over quarter, look at that EBITDA contribution. And what I would say is go back and say, what is it that we're doing uniquely or powerfully that are allowing us to do those things, those financial things? And those drivers of growth is where my energy would go. Can I call that a proprietary customer acquisition model? Can I package that customer acquisition model up so that A much larger HVAC company in terms of revenue would say, if I applied that customer acquisition model to our overall business, it would be explosive. So you're looking for those things that a buyer would say allowed you to get to where you are. It's often the things on that last page. You know, it's brands you've created, processes that you've created, what allows you to do what you do well. And people are often dismissive of that as that's just, you know, how we run our business. But you have to take a little bit deeper look and say, all right, well, why are we better than our peers? That's the area that tends to first bubble up what I sort of call strategic value.
Great, thank you.
And that really goes into this this next session or section here, finding the best buyers. So almost by default, I'm making up the number, but I would say 90% of all founders, entrepreneurs on their own, you know, if you have a talented broker, someone like Adam comes in and really helps you work through this process, you're gonna change this a little bit. But the path of least resistance is when it comes time to sell your business, you look for a larger version of yourself. If you're an HVAC contractor at 10 million in revenue, you find one at 50 or 100 or 60 and say, that's a great buyer for my business. And in many cases, that can, in fact, be a good buyer, but it's often the lowest multiple, the lowest enterprise value, because candidly, they know that business, right? They know the challenges, they know the margin, they know the risk. And so what I always recommend, and if you go kind of back to the you know, these outlier scenarios where people are selling their companies for billions of dollars at crazy multiples, almost every single time, what you'll find is the buyer is in a different industry looking to enter the one that you're already in. So you, as a seller, become the way they enter your market. So if you're, you know, I don't want to get stuck on HVAC contracting, but if you're an HVAC,
It's vital. It is a vital industry.
yeah, and you know, as an example, the path of least resistance is to go up to those larger HVAC firms and service firms. But the reality is there may be, and there are, I guarantee you, 4 or 5 other categories of buyers who are not yet in the HVAC service business, but want to be. It could be hardware manufacturers, the actual equipment. It could be companies that do, you know, like Angie's List, you know, multi sort of lead gen businesses that they actually want to not only develop the leads, which is their specialty, they want to have an in-house team that they can funnel leads to at a higher margin than the market. And so when you find people that are outside the industry that you're in that want to enter your industry, that's where the biggest outcomes tend to happen. So I can't even remember what's on the next slide, Adam, but that I know that's the point. Yeah. So one of the things that in my program, I've got a program called Exit DNA, and one of the things we do a lot, we have a spreadsheet that we start out really early in saying, as a founder, one of your first jobs is to start with a blank spreadsheet and come up with at least 3, ideally 4 or 5 different industries, and start to build out the justification of why someone in that industry would want to buy your company. And over time, you just start filling in details. What are some of the companies in that space? Who are the CEOs? Who's the head of corp dev? And that, what it really does for us as founders that's powerful is it opens up the aperture. It starts our mind thinking about, why would someone in this disparate industry even care about what I'm doing? And then all of a sudden you're like, oh, well, I bet they would like the fact that we go into a client's home and they don't have an ability to get inside a home. That's a value to some people. Maybe there's a trusted financial relationship they have with their customers that they haven't been able to crack. So there's lots of ways you can do this, but the overarching point is, if you are talking to people within your own industry, you need to open up the aperture and add at least 3 more categories of prospective buyers, because the biggest ones often happen outside the industry you're in. All right, let's talk
about one of the things we're finding right now, Mac, I would just add, one of the things to add to that is we're in Charlotte, one of the probably the top 4 or 5 cities where people are moving or growing. So someone it may be as simple as putting a dot on the map for whatever business you are. They're in the Northeast. They want to start moving down. They want to hit Charlotte, Raleigh, Nashville, these huge growth cities. And for that reason, they may be willing to pay more to come into this market. I know we see our Google traffic. It's been unbelievable in the pandemic how much our traffic has increased from the Northeast. It's to your point, they want to strategically be in these markets.
Yeah, geography is a really good example because geography can mean a number of things. The example you just gave is a really good one. Maybe you have a company on the West Coast that's looking for an East Coast presence and you're the answer. How do they get the East Coast? They buy your business. It might be your headquarters. It could be your team, your employees, right? So maybe you have a concentration of headcount that's talented human capital in an area. It could even be your customers, so maybe you have a great customer base that happened to be concentrated in a particular geographic market. Two of my companies that we sold, not the only reason, but geography was one of the drivers, that they really wanted to be. One was they wanted a US partner and we were the answer to, entering the US market. The other was kind of the greater Charlotte, southeastern US market. So that was on the pretty short list of why our business was a very attractive acquisition. So yeah, really, really good point. All right, so we can click into this. And I think this kind of naturally flows is exactly what we just talked about. But when you think about these strategic buyers that are not just looking at EBITDA, they're not just thinking about revenue, what are some of the things that they do care about, right? And so some of the things we just talked about, geographic expansion, that is one of the big reasons. Customers, that's so straightforward. You have kind of the existing business out there that is really looking to grow or diversify their customer base. You have a large organization that has some products, but sees your product as an incredibly powerful addition to their suite of products. We talked about brands. The one that I'm seeing more and more, you see it on Amazon quite a bit right now, is very, very big, sophisticated global supply chains coming out of Asia or South America that have amazing products and production, and they don't have a brand that resonates with the consumer, because the US market, for example, the consumer market here is really big. But if you have a brand that's named after an Asian manufacturer, it may be the best product on the market, but without the brand that resonates with an American consumer, they're missing that opportunity, right? So brands are big. Key hires often, and I'm not really talking about sort of aqua hires where someone buys the company just to basically get the team, but in many cases, your team, what led you to be successful, maybe you as a founder, you as a CEO, maybe your chief technology officer, key people on your team are really strategic in the growth plans for someone growing their business or entering a new industry. So that can be really valuable. Intellectual property, I'd say one of the biggest, most underutilized things that I have seen in companies I've worked with and talked to is this idea of intellectual property. I've got a great chart. I don't think it's in this deck, but shows the contribution of intellectual property to the value of the S&P 500 over like the last 25 years. And 25, 30 years ago, it was a really, really small part of the value of publicly traded S&P 500 companies. This year, or last year, 2020, it is over 90% of the value attributed to public companies is intellectual property in some form, goodwill, brands, all these things. So if anybody thinks that intellectual property is some fluffy, nobody cares kind of thing, look at the S&P and how much value is attributed to intellectual property. It is a stunning graphic. Last thing I'll say on this one is, unfair advantage. You might have heard that term thrown around. The reality is, unfair advantage to me, I've been saying it for many years, it basically means that you have something that is so good as a differentiator, the competitors will literally consider it unfair. It's just short of a monopoly, right? So you have something that is a process that's just the best one in the market. You have a patent, you have a trademark, you have your brother-in-law is the head buyer for Home Depot and Home Depot is the key customer. There's something that is truly a differentiator. The more of those things that you can find and start to stack up, the more exit value you've created. All right, let's get through
Before
this.
we go on, Mac,
Yeah.
I have two separate questions that are in the same category, so I'm going to sort of combine them. But
Okay.
essentially, how as a 3 or 5 or 10 or even $15 million company, how attractive are they for strategics? So you did a great job of going after both national and multinationals, and you weren't doing $100 million of revenue, but are they interested in these 5, 10, $15 million companies? And I think I know your answer, but some of the questions have been, how realistic is it for a $5 to $10 million business to be acquired by strategic, because they have all these costs and it's going to cost them X amount just to do a deal. So
Right.
how do you convince a large company that, quite honestly, $10 million is a rounding error in their big grand scheme? How do you convince them that what you have is worth their time and their money?
Yeah, it's a really good and important question. I mean, yes, my answer is definitively, absolutely. My background, is that, right? It's building up companies relatively quickly, relatively early, selling them when we were at 7 or 8 figures in revenue, 6 figures in revenue, in some cases. And the answer really is back to that strategic value. You have to have something that is so important or valuable, or the perceived value of that is worth it, right? And in some cases, to your point, Adam, it's actually, you could look at it as a disadvantage, or in some cases, I would even say it's an advantage to say the order of magnitude of the acquisition is so small in some cases, it doesn't even have to be disclosed. Like if you're, when I was on the board of a large public company, we're doing lots of acquisitions. At a certain level, you do a $150 million acquisition, it's a big deal, it's disclosed, there's all kinds of regulation around it. We could probably have done a 10, 15, $20 million acquisition and not even disclosed it, because it's literally de minimis. It is not material to our financials. It doesn't have to be disclosed. And so if you're a seller of a $10 million business in terms of enterprise value, that is an advantage, is to say, hey, we are literally a tuck-in for this buyer. We're handing them something so valuable that they're going to be able to really amplify what it's worth, but it's immaterial to them. It's monopoly money. And smart companies don't consider anything monopoly money, so I don't want to be too dismissive of $10 million, but it really is about strategic value. The last thing I'll say on this, which I literally was in this conversation yesterday, and it's so powerful. One of my clients was a very early stage company, just coming out of beta, 7 figures in revenue, but just barely. And they're talking to a public company, and they said, how do we really look at this? Because we're just getting started. We only have $1 million in revenue. Yeah, we're profitable, but and we have 6,000 customers, and it's in beta. And I said, you're using the wrong math. The math is, what's their math? And he said, what do you mean? I said, well, how many customers do they have? And they said 8 million. I said, all right, well, what is 0.5% of 8 million customers using your product and service? It's $60 million. It's like, that's the math. The minute this deal closes, it's worth $60 million to them. I think that's conservative. Could it be 1%? Could it be 2%? So if you start looking at these large buyers, in their hands, your asset is worth a tremendous amount. Even if you're profitable, if you have $1 million in EBITDA, that's a great business, right? Small business, great business. But the minute a public company buys it, maybe they're trading at 20 times earnings. Now that $1 million that they're willing to give you 6 times EBITDA for, it's worth 20 to them the day the deal closes. That IPO arbitrage, or that public market arbitrage, is something that you can capture as a seller. So I don't want to go off too far in a tangent, but yes, I think those are very sellable businesses, great businesses, and you'll want to use the fact that when you line up on strategic value, it's de minimis for them. It's a no-brainer. Let's see. So back to this point, really my philosophy is, when you start thinking about selling a business, you want to find that perfect buyer. You want to tell this really irresistible exit story, which is why your asset, your company is so powerful in their hands. And one of the simplest ways to do that is simply stacking the deck. It's not one reason they're buying you. It's not because of your geography. That's one of 6 things. It's your products, your team, your distribution deals, your EBITDA. The more of those things you can stack, the more likely you are to be adding to enterprise value, but also the more likely you are to find different buyers that are valuing these specific things. All right, so last critical shift, and then we can talk about any questions anyone has. But this really came about. So after my 6th exit, which was October 2018, for the first time in my sort of working life and career, I hit pause. I just didn't start my next company immediately. I wasn't working on something else. I really took the time to sort of look back over 25 years and said, what worked, what didn't, what would I do more of in the future, what would I want to avoid? And this was the result of that. And so I think the next slide, I call this the super strategy. And basically, this is the exit lens. And what that basically says, we can go to the next slide, is you as a seller, you need to start looking at your business through the eyes of a buyer. I realized that once I went back and looked at all my companies, with every single one of them, there was a point in time which we decided we needed or wanted or had an opportunity to sell our business. And psychologically, the minute that event happened, we started looking at our business differently. We started saying, what would a buyer think about this new thing we're doing? How would a buyer look at that product we're going to launch? How would a buyer consider this capital expenditure? So the minute you shift your mind to looking at your business through the eyes of a buyer, I found that everything changed. Not only was I creating a business that was more attractive to a prospective buyer, I was building a better business. I mean, it was literally like just another lens to look at my company, and it happened to be a particularly powerful one. The next slide, I talk about using, so my program's called Exit DNA, so I call them Exit DNA questions. So tomorrow, even if you're 3 years away from exit, 10 years away from exit, you don't know when or if you ever want to sell. If you start asking questions like these, it's kind of this exit lens. You look at any major decision. Let's say you're contemplating hiring a new employee. You're contemplating opening a new office. Ask, does this decision increase or decrease dependency on me if I'm the founder or CEO? Would a prospective buyer like this decision? And one example I always like is, if you're in a growing company, a very natural thing is expanding, right? I want geographic expansion. If I'm on the East Coast, I want an open office on the West Coast. Well, to a growing company, office expansion, signing a lease in LA feels really strategic. But if you put the buyer lens around that and say, how would a buyer look at this? Suddenly that benefit of a West Coast office is a real estate obligation. It is a liability, potentially, right? So all of a sudden you're like, maybe I don't really want to sign a long-term lease. Maybe I look at a co-working space, or maybe I have a work from home scenario, because the buyer lens would tell me that might be a liability that someone doesn't want to take on. And then the last thing with all these decisions is I'm asking, does it add demonstrable value? If I decide to hire this person, launch this product, is it giving me something really powerful and unique, or is it just incremental? And if it gives me intellectual property or some big competitive advantage, or really improves my margin, those are the kind of things that really start to make me feel like it's a good decision. So it's not don't let the tail wag the dog. Like, you have to make decisions the way you always have, right? Being thoughtful, being thorough, including all the people that you naturally would. My suggestion is, going forward, insert this exit lens as one of those criteria. Just hit pause briefly enough to say, and ask these kind of questions. And if it makes you feel better, again, it's just another data point. If it gives you pause, then it's worth at least considering, if you do want to sell your company, are you doing something that makes that more or less likely by asking these kind of questions?
And I just want to add here, while everything Mac has said has been really insightful and great experience, every time we meet with an owner, any of you owners who are watching this in the future, the first question I ask an owner is, when was the last time you took a 4-week vacation? And they all look at me and said, 4 weeks? We haven't taken a 4-day vacation. And the point of asking that is, if you schedule a 4-week vacation, it's going to force you to distribute responsibility away from you. And it's going to make your company that much more desirable to a buyer. And what I always tell people, and Max just done it in a different way, is take off your seller hat and put on your buyer hat and look internally, introspectively at your business. And usually in small businesses, the number 1, 2, and 3 place they go is you, the owner. So you got to get things off your plate. And so thinking about it from a buyer's lens it's just a great analogy.
So I think we have just a couple more slides. So when I look back, as I mentioned, kind of late 2018, I look back over those 25 years, and I started really thinking about mentoring and advising founders through this process because I felt like maybe I had some unique insights or ability to help, and that's what I wanted to do. I came up with this term that I called it exit DNA, because early in my career, I got really frustrated by the process of people going out and doing mission and vision and core value kind of work. And they'd get really excited at an offsite meeting. And then they would come into their back to the office, and those things would get posted in the conference room, and they would never do it. They would never even refer to their core values. They would never even look at their vision statement. So to me, and I used to say, like, if we're going to do core values, we have to weave it into the fabric of the organization. We have to live it. And so when I think about exit DNA, I call it exit DNA because I believe you have to make this part of the DNA of the business. That going forward, you have to put on that buyer hat, as Adam described it. And it is, going forward, you're going to think about, what does it look like through the lens of a buyer? And just by doing that and weaving that into your conversation, sort of the fabric of the organization, you're increasing the likelihood that you'll exit if you want. You'll increase the optionality. I think in most cases, you'll increase the actual enterprise value. But even if nothing else happens, I still believe you're building a better business, because it's just another powerful lens or filter to apply to how you look at it. So I think maybe 2 slides left.
Yep.
So
come on.
Slide doesn't want to go.
Nope. There we go.
All right. So yeah, I mean, in terms of making this stuff actionable, I don't like to do any kind of talks or presentations that I feel like I'm, preaching or anything, but I really think this is very immediately actionable stuff. It's basically going into your business, starting right away, using this lens. And I think doesn't even require the desire to exit. It's just like, hey, this is an interesting idea. Let me apply this and see what happens. Because, I think it was Einstein called compounding interest the 8th wonder of the world. I think the same thing is true of exit value. There are all these little things you can do now that will compound into value over time. If you wait until 3 months before you want to sell, or 6 months before you want to sell, and you call Adam and say, hey, I really want to exit this business, Adam's likely going to tell you, you can definitely do that. But in his heart of hearts, he's going to look at things and know that some of these things, that if you would have started them a year earlier or 2 years earlier, they would be worth a lot more now. And so that's really my kind of focus, is to say, take action on these really little things that will compound into tremendous value over time. So yeah, bottom line, you want to sell your business in the future. What you really want is, you want the option. You do not want to be forced to sell it. You don't want to have to sell it. You want the option to sell it. You want in the perfect scenario is the option to sell it where someone wants to pay you a lot of money for it. And so creating the real option, knowing that you can do it on your time frame, your terms, and maximizing value, that's what you really want.
And I would argue that there's another reason that people don't always think about, which is, people get sick suddenly. People die suddenly. Things happen in life where you're not in control. And so if you're doing these things actively in your business, if one of those circumstances arises, the company is not going to be damaged. So it's in a position to maximize the true value in the business. I got another question here. I think that was, oh, go ahead. I
Yeah,
apologize.
this is the last
Mac.
slide. So yeah, just to summarize, all the way back to the beginning, these organizations that really are the outliers, that defy the odds, that have ultimate optionality, create massive enterprise value, they do these four things really, really well. So you have to, as a business owner, starting today, shift your focus to creating strategic value, just thinking about where is that value within your business. Number two, you have to take that strategic value and develop that irresistible exit story, which is why these assets, these products and services that you've created, that strategic value, why they're so powerful to these buyers. That's the irresistible exit story. Number three, you have to be able to start identifying who these prospective buyers are, particularly those that are outside of your industry. And one of the most actionable things you can do there, I mentioned start tracking them, is if you have a list of companies that you think, you don't know, might be great buyers of your business, create a Google alert and just start literally 15 minutes a day, read what they put out in the press. And they will, over time, 15 minutes a day, reading their press releases, they will tell you where they're going as a company. And one of those days, it's gonna be like a bright beacon. They're gonna say something that you're gonna go, that's exactly what I'm building, or that's exactly why they should buy us. And so just starting to lightly track these companies over time often leads to pretty powerful outcomes. And then, the last thing is always, it is being proactive. It is starting today to develop that exit-oriented DNA that I want to use the lens of a prospective buyer. I'm going to start looking at my business and asking those questions today. So those are the four changes. If you make those changes, I think it's really, really powerful.
It's really, really great stuff. And so if someone's going to buy a business, someone's buying a business this year in 2021, how quickly would you tell them to start thinking about number four, or really all of these? Would you say on day one, or would you say, yeah, I assume you're going to say start on this immediately when you buy a company or when you found a company, but same thing happens when you buy a company, correct?
Yeah, this is one of those, the earlier you start, the more the more time you have to create value, and honestly, the lower pressure it is. I mean, all of the things that you need to do to exit have to happen one way or another. You can either do that in 3 months in a mad scramble and distract you from your business and freak everybody out, or you can start 2 years in advance, knowing that every little strategic step, which is only an hour on a Sunday, 15 minutes in the morning, those little things start to really compound. So I am a huge fan of, like, do not wait, start now.
That's great. We have one more question in here, and it's essentially, how did you, without getting too detailed, but how did you successfully convince the company, who clearly had their buyers and their CPAs and their bean counters saying, oh no, we shouldn't buy Mac's company for 10x, it's only worth 3x. So how did you sort of, behind the scenes, how did you navigate when the financial people would say, hey, this is only worth X, and you were arguing, no, it's worth 6x? Talk a little bit about that.
Yeah, I think there are a couple of, some of them are really techniques that you get into in the process itself. I mean, one obvious example is multiple interested parties. Nothing creates demand and exit value like 4 people around the table, all of which want to buy a company. So bidding war, for example. But really, I'd say the things that I believe differentiated us and kind of created that scenario more than once in my career was being very, very clear about the strategic value that we had created, making sure that that strategic value was protected. So if a buyer looks at your business, they're almost always trying to do a build versus buy analysis. They're trying to say, I can either buy Adam's company, or I could put my team on it, and in some period of time and some investment of money, we could do the same thing. And what I always tried to do, and I think did a reasonable job of, is saying, of course you could try to replicate what I have done, but I have an exclusive contract with a supplier. I have a proprietary technology stack that's already in use. So I created all these barriers around that decision that I knew they were going to try to make. Like, should we buy it or build it? And I made it look really hard for them to build it. So much so that it was worth them just paying me. So number one is just create that dynamic. The other real epiphany, if you will, for me, was using what I call buyer math. And that was kind of the example I gave a few minutes ago. It's like my company's, one of my previous businesses, I sold to a large media company. And in that process, they were like, well, Mac, your revenue is pretty low. You're just getting started. And I said, well, I have 6,000 customers using my software. And yes, they're only using a fraction, but they're truly customers. And I have one salesperson. And so my one salesperson is getting started. You have a 60-person sales team. And the minute our deal closes, you're not cold calling, you're calling customers. And so what's the math on that? And I was able to show them a spreadsheet to say, like, again, 2% of my current customers buy something else from you is worth millions and millions of dollars. And it's just so hard to refute the math, because they're basically selling against themselves. Oh, you're telling me you can't convert 0.5% of your current customers to the best product in the market? Like, come on now. So a lot of it was just really knowing what those dynamics were. And once you line them up, it's really hard for them to kind of argue that.
That's a great point. And I would also argue, now Mac has spent the last 45 minutes here talking about strategic value to a large company. Majority of the businesses we sell are to individuals. And I would tell you, as a business owner, you can sell strategically to an individual compared to where they're coming from. So if you have a nice recurring revenue business and you've got a very unique product or a very unique service, that might be much more compelling than them staying at their job downtown in a corporate environment. So it's different, but you're helping them make a strategic choice to change their what they're doing. So they're going from the corporate world strategically into the world of entrepreneurship. So I think a lot of these principles that Max talked about don't just apply upward, but they also can apply to the $2, $3, $5 million business who could be bought by an individual. And so I'm just saying, maybe widen the lens a little bit, because strategically they're looking at, do I do 10 more years in the corporate world, or do I go out and go and try and do this from an entrepreneurship mentality? Well, this has been great, Mac. Really appreciate it. Here's both of our information here. Mac is all over. You just need to Google Mac Lackey. Exit DNA is a great program. He's got tons of great information on his website. A little bit about, you can find all of our information on our website. And I would be remiss if I didn't let you know, next month we're going to continue on this approach. We're going to talk with Rene Rabena, who we help sell his home technology solutions business, where they go into companies and residences and help them wire their world. And I can tell you that the buyer who bought this made that strategic choice that we were just talking about. He was tired of the corporate world and said, this is going to be a great entree. So we're going to talk about some, his process going through, growing a nice business over 15, 18 years with his brother and other family, and how they had a really successful sale. So Mac, really have enjoyed this time and your wisdom and knowledge. And for those of you who are interested in the PowerPoint, everyone who attended, I'll make sure that you get a copy of this, of the video. And if you want the actual spreadsheet, reach out to me or Mac directly. So Mac, really appreciate your time and your unbelievable experience and wisdom, and enjoyed this talk.
Yeah, thank you very much, Adam. Appreciate you having me.
Okay. And thanks everybody for joining us. And again, this will be available on our website in a couple of days. And if you have any questions, feel free to reach out to Mac directly or myself. Thank you all very much.